3 stocks to buy September 2018. That's what we're talking about today, guys. Now, I make these type of videos every single month and basically all the time, so make sure that you're subscribed and hit the notification bell to get more content like this. Also, in last month's video, we got over 150 likes on that video, and I don't think I've ever reached 200 likes on a video. So if you guys could please support the video, support the channel, hit the like button. Let's see if we can hit 200 likes on this video. That would be awesome. But with all that said, let's go ahead and get started. What's up, everybody? My name is Ale. Welcome to my world of finance. Today we're going to be looking at 3 stocks that I don't currently own, but I do have I have a really big history with 2 of them. But I am bullish on all 3 of them in the long term, and I may open a position very soon, especially if I see a significant dip to jump in. If you want to know what my 3 largest stocks are, you can find that up here in the description below, or I'll have it clickable on a little card at the end of this video. But again, the 3 stocks that we're talking about today, I am extremely bullish on in the long term. Anything can happen in the short term, but if any of them dip in the short term, I can almost guarantee you that I would be grabbing a position very quickly on any of these 3 stocks. I really like these stocks, and I definitely want to add them to my portfolio as soon as possible. All right, now stock number 1 is actually a gaming stock. Now, I know that my number 1 biggest stock is Nintendo, so we talk about Nintendo a lot on this channel, but I also understand that a lot of you may not actually like Nintendo. Maybe you don't like Nintendo, or you're just not invested in Nintendo. So today I thought that I would throw in a second gaming stock. Now, this gaming stock is actually Activision Blizzard, ticker symbol ATVI, and I used to have a very large position with Activision Blizzard, but I cashed in those profits a while ago. Now I am definitely looking to jump back in, especially if I can get them at the right price. Now currently Activision Blizzard is trading for around $70 per share. Year to date they're up over 10%, and their 5-year performance is incredible, up over 300%. That is insanely high. Now when looking at the gaming market in general, I've got this chart right over here from Newzoo.com. Newzoo.com is like a gaming research firm, and they show revenue data on this chart here from 2012 to 2021, what it's projected to be at that time. And you can see that revenue has increased every single year and is expected to continue. And not only is gaming revenue already worth well over $100 billion, but it is definitely on track to hit $200 billion in the not too distant future. So I think getting in relatively early on gaming related stocks before the gaming market matures, I think could be a huge benefit. And when you look at this chart here, it has the gaming market separated into the 3 different segments of PC, console, and mobile. And you can see that definitely the piece of the pie for mobile is definitely growing. But when looking at Activision Blizzard, one of the reasons why I really like them is because they are heavily involved in all 3 segments: PC, console, and especially mobile. In fact, Activision Blizzard is really the total package when you look at these different segments. They consist of Activision, Blizzard, and King. And so when looking at those 3 different segments, they can kind of shift around a little bit sometimes, especially Activision and Blizzard. But when looking at Activision, that segment mostly focuses on consoles. When looking at Blizzard, that segment mostly focuses on PC. And then when looking at King, that mostly focuses on mobile. So it's really the total package. In fact, King released the mobile game Candy Crush Saga over 6 years ago. And in just their latest quarter, Activision Blizzard reported that Candy Crush brought in over $200 million, which represents a growth of 18% year over year. That is incredibly impressive, considering that this is a game that is already over 6 years old and still showing growth rates in the 18%, almost 20% year over year. That's incredible. On top of that, Activision Blizzard owns incredible IPs when you look at Call of Duty, Overwatch, and Warcraft. And when talking about Call of Duty, not only do we have the next iteration of the very popular Black Ops series coming very soon, I think it releases in October with Black Ops 4, but it was also recently announced that Activision is partnering with Tencent in China. You may have heard of Tencent, a huge company in China, to release a mobile version of Call of Duty in China as well. And so we just talked about how important the mobile market is. They can bring some of their IPs to the mobile market. And what's really great about this is that Call of Duty for the mobile market is actually going to be a free-to-play game. And I think that that is great news, because that means that it will definitely have microtransactions. And as much as consumers hate microtransactions, it is really an investor's best friend because it means high profit margins and consistent revenue being generated. Not only that, but just the fact that it's a free-to-play game, that means that it's going to be downloaded by an enormous amount of people because it's free to download. And then once you get hooked on it, then you start paying for some of these microtransactions and it starts bringing in a ton of revenue. I completely understand. People don't like microtransactions. I'm one of them. But again, as an investor, it really does benefit you a lot. And if all of that wasn't good enough news, Activision Blizzard also pays out a dividend. And while the yield is currently pretty low at around 0.5%, Activision still has a long track record of not only paying dividends for years, but also increasing them. In fact, when you look at the 5-year average growth rate, it's in the double digits. So with the gaming market and even the esports market currently booming, incredibly strong IPs, a presence in all gaming segments when looking at PC, console, and especially mobile, and a growing dividend, I think Activision Blizzard is really a no-brainer stock to look into, especially for the long term. All right, now stock number 2 is actually a stock that has been heavily requested on this channel, and a lot of my viewers and subscribers are actually very bullish on this stock, and they always tell me to look into it. But for one reason or another, I've just never put in enough research on this company to really have an opinion on their stock. But with the rise of autonomous robots and just technology in general, I started to realize that I should probably look into this company, and this is iRobots, ticker symbol IRBT. And once I started doing some research, I found that this was actually a stock that I really like. Now, you've probably heard of iRobots. They are pretty well known for their Roomba vacuums that go around vacuuming everything. They're also pretty famous for their pool cleaners. A little bit of a side story, I actually used to have this field job where I used to work with like electric poles and stuff. So I would need to get into people's backyards, and a lot of times I'd go into these really nice houses that have these really nice pools. And I used to always look at the pools, and there'd be these like a little robot that would just be submerged inside the pool, and it would go around the pool cleaning the entire pool. And I always thought that was pretty cool. But yeah, that's definitely iRobots. They have a lot of these pool cleaner robots. But they're also expanding their portfolio with proprietary technologies in new products, and especially in the connected home and the smart home markets, which, by the way, we continue to see grow more and more with these giant companies jumping into that market like Amazon and Google and even Apple. In fact, last year, iRobot's sales of consumer units were up 20%. That's incredible growth that I think will continue to increase in the future as the market grows right along with it. But we'll talk more about that in just a second. Now, a quick disclaimer, this is actually a pretty young company. It was founded just a few decades ago in 1990 by 3 MIT graduates that were designing robots for space exploration and military defense. Now, because this is a relatively young company that has a lot of hype behind them, they do obviously have a pretty high PE ratio. According to Nasdaq.com, their PE ratio rounded off was 49 last year, excuse me, and then it's estimated to be 36 if looking at this year's earnings, and then if looking at the earnings of 2020, it would be at around 24. So at the very least, it does go down when looking at future earnings. Now, currently they're trading for around $87 per share, and they're up around 15% for the year. Now, having said that, I may have already scared off a lot of value investors, but when looking at their balance sheet, I was actually pretty impressed because this is generally considered a growth stock. And so looking at their balance sheet, I was pretty impressed. Now, last year they had a current ratio of more than 2-to-1, and then their asset to liability ratio was around 3-to-1. So that's pretty impressive considering, this is a growth stock, relatively new company, has a lot of hype behind them, definitely investing heavily in its future, and still has a pretty decent balance sheet. So that's definitely a plus. Now, when looking at their business and the market that they operate in, we're continuously seeing an increase in demand for applications that connect all kinds of devices in the consumer's home. That's generally what we consider a connected home or a smart home. And because consumer robots will likely play a big role in that one way or another, and especially as we move towards a more technological future, a lot of different firms, like analytical firms, are raising their forecasts for how much these markets will be worth in the future. In fact, one such firm, the Boston Consulting Group, raised their forecast recently for the consumer robots market. Back in June of last year, they actually published an article about it. I'll have it linked in the description if you want to check it out. but they basically stated back in 2014 that they expected the market to be worth $67 billion by 2025. But just last year, they increased that target to $87 billion, mostly due to growth in the consumer market with self-driving cars and devices for, guess what, the home, what we just talked about. So devices for the home, and the rest of it being in the commercial sector. So listen guys, I don't think there's any doubt that consumer robots will play a huge role in our future as technology continues to advance, and being able to invest in a company that is heavily involved in that market before that market matures and with a pretty solid balance sheet, I think that makes iRobot definitely a stock worth tracking and looking into. Now, I know that they're a little pricey, but man, if you see any kind of significant dip, or if we hit a recession or any kind of market crash, I think iRobots is definitely a stock worth picking up, especially for the long term. All right, now the last two stocks that we looked at are definitely a lot smaller than this third one that we're going to look at. And you could probably argue that they are also maybe a little speculative as well. We were talking about their markets growing in the future. So you could maybe argue that they're a little more speculative. Now, this third stock is definitely trendy, but it is a massive company that has not only been dominating in the past, but will continue to dominates right now, and will continue to dominate in the future. And I think it's really a stock that you could buy now and basically just hold forever. If you already have this company, I wouldn't be selling. I would just hold it basically forever, or as long as you can. Now, that company is Google, or if you want to get technical, it's Alphabet, but I don't like saying Alphabet. It sounds too similar to Apple, and then I get confused, so I just like saying Google. Their ticker symbol is GOOGL. Now, I have a long history of investing in Google. I used to have a big position in Google. Unfortunately, I needed the money, and it was one of the biggest stocks that I had, and I just really needed that money at that moment. It was a little bit of an emergency moment, so I had to sell out. But I really want to jump back into Google. I would like for them to dip, but I don't know if we'll ever see a significant dip unless we hit a recession or a market crash or anything like that. But again, like I said, this is a company that if I owned Google right now, I don't think I'd ever be selling again unless I had some sort of emergency. Now, they're currently trading at a pretty expensive price, over $1,200 per share, with a trailing PE ratio of around 54, which is definitely high. But when looking at their forward PE ratio, that's half of that at around 26. That's actually pretty good considering it's Google that we're talking about. I mean, you look at some of these other giant companies like Amazon. Amazon is around 3 times that at around 76. And then you look at a much more closely related company like Facebook, who, by the way, also generates most of the revenue from online advertisements, so it's a very similarly related company, and their forward PE ratio is barely lower than Google at around 22. And honestly, I think that Google is a much better company than Facebook, so that's kind of interesting. Now, when you look at their 5-year PEG ratio that factors in future growth, it's actually looking pretty good for Google as well. It's at around 1.7. And that's considering that it's Google that we're looking at. I don't think it's too high. Ideally, we would like it to be 1 or less. But you look at some other popular stocks. I mean, recently we talked about Coca-Cola and PepsiCo, right? When looking at their PEG ratios, Coca-Cola was higher than 3 and PepsiCo wasn't too far behind. So I actually think that Google's PEG ratio is actually not too bad considering the massive company that you're getting for that price. Now, why do I like Google so much? Well, the biggest reason why is because not only does Google continue to dominate, but their business and everything that they do is so incredibly hard to replicate, let alone compete with. When you look at the Google search engine, realistically, do you see any other company being able to compete with Google search? I mean, I don't think we'll ever get to a point where people want to search for something and not use Google, right? It's literally become a verb. It's like, oh, you want to know what that is? Google it, right? It's like a verb. So, and honestly, the only other company that I've ever seen compete with them in that regard is Microsoft. And Microsoft is this huge, massive company as well, and they've had an incredibly hard time marketing Bing Search, their search engine. And the only time that I've ever used Bing Search was when I had a Windows phone, and the default search engine was therefore set to Bing Search, and I would actually receive reward points for using Bing Search, but we all know how Windows Phone turned out, so it can't really compete with it. In fact, that dominance has led to Google controlling over 90% of the internet search market that brings in enormous revenue. In fact, when looking at the online advertising market, Google accounts for around 42% of online ads. The next closest competitor is Facebook with only around 21%. And then you look at YouTube, and it's this massive video streaming platform that continues to dominate the world with over 1.8 billion, that's right, 1.8 billion monthly users on YouTube. And when you just look at the numbers that they put out in the US, they have over 40 million more viewers than their next competitor, which is Netflix, and they easily eclipse rivals like Amazon, Hulu, and HBO Now. Now, technically, yes, if we were to look at paid subscribers, YouTube's numbers would be horrible in comparison, but I do have two thoughts on that. First of all, I don't even think that YouTube needs a paid service. I think that they generate enormous amounts of revenue just from advertising alone on their free service. And even when looking at their paid subscriber count, which is definitely low, in the US it's probably in the low single-digit millions. That just means that they have plenty of room to grow as well. And the second thing is that the video streaming market is becoming heavily saturated with a lot of competition coming in. We know that with Disney, right? My third largest stock is Disney. We know that Disney is entering the video streaming market. So there's a lot of competition there. But the great thing about YouTube is that YouTube isn't directly comparable to all those paid subscription services, because YouTube is mostly this free platform with user-generated content, and they're just so far ahead that it really shows that people love user-generated content. And not just that, but because they have so much backlogged content, and because everybody is already doing YouTube, everybody's already aware of YouTube, it's just going to be so incredibly hard to dethrone YouTube. Sure, other platforms can come out with user-generated content, and maybe they will survive, but I highly doubt that they will ever be able to overthrow YouTube. I just don't see it happening. So if you really want to dethrone YouTube with your own user-generated platform, good luck, because you're probably going to need it. And then we look at what Google is doing in the cloud segment, and this is really the first time that we see Google trailing behind any competitors in a market. And really the reason why is because Amazon and Microsoft, two massive companies, really dominate the cloud services market. But I still think that there's a lot of potential there for Google, because that just means that there's a lot of market share that they can steal. And I really don't think that the cloud market is as set in stone as some other markets that we've discussed. If a company offers cloud services for a cheaper price or with more innovative functionality, which by the way Google is doing with their proprietary artificial intelligence to improve customer service, then commercial customers, I think, will be very likely to switch, and they won't even think twice about it. And just in their last earnings report, Google announced that their cloud segment is already delivering over $1 billion of revenue per quarter. Microsoft and Amazon are much higher than that at over $6 billion, but the fact that Google's other business segment that includes cloud numbers represented a year-over-year growth of 42%, that doesn't mean that Google is just surviving. That means that they're actually thriving. And then who can forget about Google owning the world's largest smartphone operating system with Android, which currently has higher loyalty rates than even Apple's iOS by around 3%. And in 2017, Apple only shipped around 15% of total smartphones, while Android was like much higher than that, eclipsed their numbers at around 85%. So with business segments that are not only growing but are incredibly difficult to compete with by rivals, I think Google is a fantastic company, a fantastic stock, worth looking into, especially for the long term, and you could really hold it for as long as you want. I am extremely bullish on Google. But who cares what I think, guys? It matters what you guys think. So make sure you let me know, how do you feel about these three stocks? Let me know in the comment section below. Don't forget to like the video, support the channel, make sure you're subscribed, and I hope you all have a wonderful, beautiful day and that you take care. God bless. Bye-bye.